The 1970s and 80s boom was built on a dangerous premise, that high inflation and rising land values would last forever. Farmers borrowed heavily, often on variable rate loans, using their soaring land equity as collateral instead of projected cash flow. When the Fed aggressively hiked rates to fight inflation, payments exploded. Land values crashed, wiping out equity and creating the perfect storm of the farm crisis. They forgot the most brutal lesson: cash is king. The farmers who survived the 80s were not the biggest, but the most efficient. They were masters of cost control. They were the first to liquidate non-essential assets to pay down debt, and critically, they were proactive in restructuring variable debt into fixed-rate loans, locking in their cost of capital to gain predictability. They learned to underwrite their business based on worst-case price scenarios, not the best-ever year. Today, we face high input costs and rising rates again, but the lessons hold. Smart borrowing means basing all loans on a rigorous, multi-year cash flow projection, not just collateral. Modern risk management demands hedging against both rising input costs, locking in fertilizer prices, and rising interest rates, securing long-term fixed rates. Maintain strong working capital, your liquidity cushion, and communicate early and often with your lender. The difference between opportunity and a trap lies in financial prudence. Today's stability is your chance to lock in costs and build resilience. Use the history books as your guide. Avoid excessive optimism. Structure your debt conservatively, and prioritize cash flow over expansion. Share this to help a fellow farmer secure their future.